Good morning, everybody. You are watching a live daily market outlook from Windsor Brokers for the day Friday, 22nd of February 2012. We are at the end of another week that was quite turbulent, especially in its second part. We're talking about yesterday's strong movements with the markets at this point in yesterday afternoon. We're talking about Wednesday's movements. I do apologize. In yesterday's session and today's beginning of the day, showing that most of the instruments are in the consolidative, still consolidative rather than corrective mode, following heavy losses that most of the counterparts of US dollar made actually. As euro is above at the beginning of European session is above 132. Sterling is holding just below 153, still away from some important levels and break points, but showing some signals of recovery following heavy losses that suffered. But we're talking about these two instruments. Still underlying bear trend is quite strong and still sees more potential towards the downside. The only one, as we said yesterday, unaffected by the recent movements, especially the Fed's action, is dollar yen, that is still entrenched within 92 and 94.45 range. Slight weakness seen yesterday under 93. That's the bottom of the narrower range, part of the range within the bigger range. It's was short-lived as the price is again above 93, showing no direction at this point. Dollar Swiss holds its positive tone following yesterday's final break above 93. Psychological and Fibonacci resistance 93.32 seen so far, and a brief correction lower is still seen as a corrective, although the break below 92.50 zone, that is the previous range top, would be quite harmful. Top loser is crude oil, that extended its losses below 95 base and basically established a fresh bearish negative direction on a slit yesterday to 92.63. This was the lowest seen so far, with the subsequent very narrow range consolidation, most likely seen preceding further weakness. We're going to elaborate more of this in the technical part, as crude oil is in the some strong technical supports, while gold remains in the near-term corrective action of fresh low at 15.55 posted yesterday. 15.83 were still below psychological 1600 level. The Fed's comments 2 days ago are still the top subject in the markets, as two top Fed officials yesterday signaled support for scaling back the U.S. Central Bank aggressive bond buying program. That adds fuel again to a continuous debate over how long the Fed should continue its extraordinary measures to support the economy. The James Ballard, the president of St. Louis Federal Reserve Bank, and Richard Fisher, president of Dallas Fed, as both considered as inflation hawks, led support to the argument favoring a move to tighten monetary policy. And another policymaker known for his dovish stance said the Fed should keep buying bonds until well into the second half of this year. The latest remarks from the Fed top officials amounted to doubling down on their previous comments, underlining a long-held divisions among the central banks and 19 policy makers. They come as investors grow increasingly sensitive to signs of policy change, and as data on Thursday indicated that U.S. economy continues to struggle to regain strength. Recall the PMIs that came yesterday, both from Eurozone, Germany, and the US, came significantly below their expectations. As I checked the calendar yesterday, all the releases were in red points, that the release came below the expected levels. That shows that economies both in Eurozone and the US are still struggling and still lacking any momentum, stronger momentum to pick up the recovery, and as immediate result we had a current turbulent markets in past couple of days. Just a few comments I would like to add about Forex itself. After several lackluster years in the foreign exchange trading, the 5 trillion Forex market has bolted back to life with institutional investors now leading the charge, and banks standing to gain from the activity. Currency volumes spiked in January, and they have stayed quite strong so far, thanks to unexpectedly strong and persistent rallies in the euro and the weakness in the yen. Demand from institutional clients and increased flows in world equity markets. A strong mergers and acquisitions sector has also boosted the overall turnover in the world's largest financial market, as often large volumes of currencies need to be traded for cross-border transactions. Global mergers and acquisitions volume hit more than $158 billion so far in this year, in 2013, more than double than activity in the same period in 2012, and this is according to the comments from Reuters deals intelligence. And it's not just leverage the customers betting on where FX is going. It's again more real money business, more hedging, and bringing longer term players back into the markets. Just a brief comment about reviving again Forex market that was in a sort of stagnation in the past periods. As current comments say, we are again increasing the pace of the movements in the Forex. Quick look at the calendar today before we move to the technicals. Not much compared to yesterday's one. German quarterly GDP for the fourth quarter came unchanged and as expected, minus 0.6%. So no changes in this. More focus is seen on the German IFO business climate for February. That is expected to pick up. Recovery 104.9 is the consensus for today compared to 104.2 in the month of January. Of course, the positive release according to the forecast or better will be good signal, and of course will be supportive for the single currency, as Germany is the #1 economy in the Eurozone. Retail sales from Italy are the lowest significant release today, with the yellow mark, 0.3% in December compared to minus 0.4% in November 2012, showing some improvement in the retail sales. Of course, this is mainly due to the Christmas shopping. Retail sales from Canada due at 13/30 January release, showing most likely expected, I think, minus 0.3% contraction compared to 0.2% in the December 2012, while core retail sales are expected slightly to improve by 0.1% in January compared to minus 0.3% in the month of December 2012. And then inflation in Canada 0.3% in January compared to minus 0.6% in December, while the core CPI is expected at 0.2% versus minus 0.6% in December 2012. And that's all for today. So we have the important IFO business climate due at 9 o'clock GMT, and then Canadian data would be the only interesting thing released today. FOMC member Powell is due to have a speech at 15:30 GMT. Importance is quite low, as we see it in the yellow color. And pardon, not to waste some more time in talking, we're going to take a look at instruments, our Forex pairs and the commodities to see what we can expect today. As said, euro is in a brief corrective, consolidative corrective mode. We see some stronger action at the beginning of European session, following yesterday's slide to this 6 weeks low at 131.60, and the initial recovery was capped at 132.30. That comes now under pressure. If we measure the last Wednesday's whole slide from 134.30 to 131.60 seen last night. This marks slightly above 23.6% retracement, and more significant levels are above here. 132.53 is the currently 55 days exponential moving average of the 1 hour chart, and then we have 132.63 as 38.2% retracement. I would say anything below 133 would be seen as a mild correction, and they will not affect further the current situation, current quite strong bear tone that dominates on the lower time frames. 133.00 previous strong support now acting as resistance, and this is also equivalent to 50%, approximately 50% of the last Wednesday's slide, seen as a trigger for possible stronger corrective action, as also they were at the end of the week, and quite strong profit trade taking despite strong bearish tone that still dominates on the single currencies. Near-term movements, as we can see on the daily chart slide from 137.10 high of 1st of February is still well in play, as the price broke below the main bull trend line at 132.20 approximately, and then cracked another very significant support. We mentioned yesterday 131.85 and 131.70 previous peaks of September 2012. This is seen as a break point, and okay, there was no clear break, but denting this level signals that possibility of further extension lower is quite likely. Now, as recovery is underway, break above 133.00, and we are talking about clear break, sustained break above this level would delay immediate bears in favor of some stronger corrective action. And then we have quite interesting situation. 133.70 is, pardon, 133.50 is the previous low, then 133.70 is the 38.2% of the entire down leg from 137.10 to 131.60, and the static barrier peak of 20th of February at 134.33, basically where the latest slide commenced, is also equivalent to 50% halfway of the 137.10 to 131.60 descent, and basically break above this level would be seen as the break point and trigger for some stronger corrective action, and will put aside the near-term bears, an open way towards the upper levels. From the other side, any reversal under initial 133.00 would keep increased risk of lower top and fresh extension lower, especially that what we already mentioned, the important support and the break point at 31.85.70 has been cracked, and the sustained break below this level would be a trigger for some stronger weakness. We have on the downside levels at 131.30. We can see them, I think, on the daily chart. If I'm not mistaken, 131. Wow, quite difficult to find it. 131.30 is the, okay, it's on the daily 90 days moving average on the daily chart, and 131.25, which is the high of 5th of December 2012, seen as the next downside targets in case of break lower. So far, the main bull trend line of 120.42, currently at 132.32, has capped the recovery, as we can see it here. Approximately the trend line is here. Holding below this keeps immediate focus down towards the lower levels, while break above here requires clearance of 132.63 as 38.2, and then more significant 133. Now, also we have to keep an eye on the weekly close, whether it's going to occur under 133. That will confirm the bearish breakout, or above 133. That could be signal for some a stronger recovery. And negative news that came yesterday are not very supportive for the single currency, and especially the comments that the euro was overpriced in the recent 7 months rally from 120.42 to 137.10. I think we are in the wrong chart. We're talking about rally from July to February to January 2000, July 2012 to February 2013. January 2013, I do apologize. Requires some stronger corrective action. Also supportive for the fresh bearish resumption is the situation on the daily chart, as the indicators are below their midlines, all pointing lower. That could be initial signal for some fresh extension lower, as we have already mentioned, the 131.30 and 131.00 seen as the next downside targets in case of bearish resumption. British pound has regained some ground after hitting a fresh low at 151.30. These are the levels last time seen in 2010. I do apologize, somewhere here. And important is, of course, a break below the bearish breakout below the major support at 151.30-60 zone range floor since 2010. Now being taken out. That is signaling further weakness of the pair, and our near-term target remains at psychological 150 level, with the 151.00 seen as an interim support, as yesterday's slide approached this level on the dip to 151.30. Now the hourly structure has improved as the pair regained some ground, bouncing above 152 and approach basically bouncing above 153. 153.20 was seen so far, and this marks approximately 61.8% retracement of the entire down leg. This sharp slide of from Wednesday from 154.45 to 151.30, but quick reversal lower still sees the downside pressured sideways toward, and the downside moving indicators on our chart show that possible exhaustion is seen at this point, while quite extended 4-hour indicators that start to point higher do not show much of the prospect for some stronger recovery, especially that initial barrier 61.8% and the 20 days exponential moving average so far keep the upside limited. As the larger picture shows, the down move from 158.43 to 151.30 shows the quite good barrier at 154 that marks 38.2% retracement, and basically regain of this level is to provide the near-term relief and allow for some stronger corrective action. But as said, overall bearish trend from 163.80 still sees no end at this point, unless we regain some more significant levels, such as if the retracement of the entire down leg. Then we have 154 zone is only 23.6. More significant is the 156.30. 156.30, these are the previous lows, and 38.2%. Now from the other side, the important levels, I don't think we can see it here, we can. The important thing is that the price regained the previous very strong and critical support at 152.30-60 zone, and if we sustain gains above this and weekly close above these levels, could be initial signal for some a stronger corrective action. Again, it's just seen as corrective. As we said, quite strong bears are still firmly in play and require more action higher. I would say minimum 156 to be regained to confirm that the immediate downside danger is averted, and will shift the focus towards the upside. Otherwise, quite likely scenarios is seen on a certain extension higher, lower top, and then fresh weakness that is initially targeting 150.00. In the near term, levels to watch 153.20 previous high posted over this morning actually, and 153.70 is the 76.4% retracement. Of course, 154.00 is 38.2 of the larger down move, is seen as the important barrier. Firm break above 154 is to signal some stronger corrective action, and of course holding above previous strong support 152.60, 152.30 would be seen as a supportive element. Otherwise, weekly close below these levels would confirm the major bearish breakout and the signal that further weakness is quite likely. That does not rule out not only 150.00, but possibility is quite high for extension down towards 142.30, which is the low of May 2010. Dollar yen, we're not going to talk much about, as it's still within its range. We can see it nicely on the daily chart. I do apologize. 92.00 on the downside, 94.45 on the upside. 92 seen as a near-term base, and the only break here is to signal some stronger bearish action down towards 91.53 is the initial 38.2% retracement, and then 91.00 approximately, which is previous highs, and then 90.63 50% retracement. We're talking about uplift from 86.81 to 84.45. Near-term structure is still negative, though some is still neutral. So some negative tone has appeared on yesterday's slide below 93.00, but quick recovery above this level is still keeping the range firmly in play, as we are within and now widen the 92.76, 94.00 range, and any break above or below these levels is to focus the larger range boundaries, 94.45 on the upside, the 92.00 on the downside. Of course, to establish fresh direction, break of either side of either 92 or 94.45 is required. The underlying bull trend is now showing signals of exhaustion, as we mentioned in the few previous sessions. Descending daily indicators coming out of the overbought territory could be initial signal. Of course, confirmation requires a clear break below 92 to signal that we are in the stronger corrective action. And finally, dollar Swiss extended its steady recovery from 90.20 base, we are in the 1 hour chart, to 93.32 so far, after breaking above 93 psychological and Fibonacci 76.4% resistance, keeping the focus at the upside, as 4 hour studies remain well supportive. Now a certain weakening seen on the hourly chart following pullback from 93.32 yesterday's peak down to as low as 92.81, where the hourly 55 days exponential moving average contained the dips, and this is seen as a quite good support in case the price held above this level. This is close to 38.2% retracement of the entire rally from last Wednesday's low at 91.82 to yesterday's peak at 93.32, seen as an ideal reversal point, as we have also previous low at 92.73 of yesterday's intraday low, and the fresh rally through 93.00 is to refocus 93.32 for possible bullish resumption of from 90.20, and the test of our key barriers, double top 93.81 and 93.87, break of which is required to open way for some stronger recovery. This also marks a 38.2% retracement of the larger 99.70 to 90.20 down move, and seen as a break point that will confirm a base at 90.20 and the open way for recovery towards we have dynamic resistance at 94.35, which is daily 55 days exponential moving average, and then it's 95. Also between this we have the daily 200 days moving average at 94.34, which is approximately at the same level. So 55 weekly 55 days moving average and the daily 200 days moving average are seen as a quite strong barrier at above 94 at 94.35, and then 95 zone that marks 50% retracement of the entire down move, and they also close to the previous 11th of November 2012 high at 95.11, seen as a break point. On the near term, again focus at 93.30, then 93.81, 93.87. Of course, weekly close is going to be quite important. Weekly close above 93 is required to signal recovery is underway, and the holding the firm tone. Otherwise, failure to close above this level, closing below 93.00, would signal some stronger reversal. Initial support is the previous consolidation top at 92.56, and should ideally hold any stronger dips in order to keep immediate bulls in play, while any slide below 92.00 and 91.82 last Friday's low would revive bears, and this signal end of the current corrective action of 90.20, as this will open way down towards 91.50 and 91.00. And a quick look at commodities before we end, as we are a bit running out of time. Crude oil set bears are now in play in the lower time frames, while the larger picture bulls have been sidelined, and the break below 95.00 as initial base, and the near-term consolidation range floor has triggered a fresh corrective action. Now we can see the over 38.2% has been retraced of the rally from 85.20 to 98.63. Also, we lost the channel support that was at the upper levels at 96, around 96.50. Now fresh extension down to below 93.50, which is 38.2%, and 93 psychological support so far reached 92.63, cracking the daily 55 days moving average, and seeing potential basically for some stronger reversal, as daily MACD is now attempting below the midline, that is confirming the negative near-term stance, and way down towards 92.00, that is seen as a very important level, psychological support, and 50% retracement of the entire rally. Down back to the lower time frames, overextended conditions on both 1 and 4 hour chart are signaling some corrective action. There is initial basic attempt seen above overnight, yesterday's low at 92.63. Still a lot work ahead in order to improve current situation and signal some more significant recovery. A break above 94, where is approximately 55 days exponential moving average, and the 94.50, where is 38.2% retracement of the rally on of the down move of last Wednesday from 97.47 to 92.63, with regain of 95 see as a break point and the key barrier. Previous range floor that marks also the 50% Fibonacci retracement of down leg of last Wednesday's strong fall from 94.47 to 92.63 is required. The break above 95 is required to signal some stronger, more significant corrective action. Otherwise, anything below here would be seen as a brief corrective action, and preceding a fresh extension. Lower downside, as we said, we have 91, around 92, which is the 50% retracement, and then extension down should be looking for test of 90.30. These are the previous highs of December 2012, as well as 61.8% retracement, and reinforced by 200 days moving average. We have two golden crosses at this point that are still underpinning the recent strong bullish action of 85.20, and basically violation of as the first the moving average 55 days one has already been taken out, violation of further downside supports 90.90, which is 55 days, 90 days one, and the 90.46 200 days one is seen as required to confirm a bearish stance in the near term, and the end of the corrective action from 85.20 to end of bullish action, pardon, from 85.20 to 98.63. So levels to watch on the downside initially is 92.00, and then very significant is around the 90.30.40 zone, where we have the 61.8% previous highs, and close to it is also the 90 days moving average. Now back to the lower time frames. Current bounce, as we said, facing around the 94 level as initial, and then 94.50 and 95 seen as a breakpoint. So we should be looking on the 95 on the upside or 92 on the downside in order to have a more clear picture, but still a bearish tone dominates on the near-term action, especially after losing 95 base, and more focus is still seen towards the downside, as the current corrective action doesn't show much of results, and seeing that skipping possibilities of further weakness quite high. Of course, the end of the week is also seen as the clearing position, so some short covering could give additional boost to the near-term price action of the crude oil. And finally, gold. Let's find it. Shows signals of basing attempt and recovery of fresh low posted yesterday at 15.54. This was, recall, this was one of our downside targets. I mentioned the interim supports at 15.54 and 15.48. We reached the first one ahead of the more significant 15.26 critical support. I'm just trying to find this chart. Where do we have it? I think it's here. Well, we're here. So let's just remove unnecessary things. And still a strong bearish tone dominates on the larger time frames, although they quite extended the daily situation, showing overextended conditions on the daily indicators, with some initial reversal signals seen already on the RSI that is attempting at its breakpoint line, while MACD is still firmly pointing lower. Momentum is showing some signals of reversal as well as stochastic, but still no clear signal of any stronger reversal. The previous low at 1600 and the psychological support is seen as the next very significant resistance, and basically this break above this level is to provide near-term relief and the signal possible stronger recovery of the sharp down move, steady down move from 1685. This is the lower base of the larger down move from let's say 1795. This is October 2012 peak, and then we have a series of lower tops, 1750, and the latest one is 1700 as well as 1685. So basically the latest quite sharp slide requires regain of minimum 1600, and then we have 1620, which is 50% retracement, also close to the previous lows at 1625 and the 1635. These were the previous very strong supports and the previous lows. Now break above 1600, and these levels, as we can see, they are also marking now the 38.2% is 1600. 1620 is close to 1625 previous low, and 1635 is exactly as the previous low of 21st of December that marks 61.8% retracement, and let's say that break above these levels would be quite supportive for some stronger recovery. Otherwise, quite a negative tone that has been established in the short term. It still sees a risk of possible extension and test of our critical level, and there's very strong support as well as a break point at 1526. More focus is still seen towards the downside, but as said, end of the week brings some position clearing, and most likely we might see some stronger move higher. But as I mentioned, anything below 1600 as initial and another significant 1625.35 would be still considered as a brief correction and preceding a fresh weakness. And that was all for today. Unfortunately, we didn't have that strong action yesterday like 2 days ago, so we didn't have much to talk, but still market is quite active, and especially that we are at the end of the week, we might see some stronger movements even today. If there is any question, please, and now you can send them. It seems that I mentioned everything and leave you all without any comment. If no questions, I would like to thank you all for attending, as usually attending our live session. Anyone, whoever connected later can find this session soon loaded in the YouTube on the Windsor Brokers Forex page. Wish you nice end of week, nice Friday, of course, and of course nice and relaxing weekend. Expect to see you again on Monday, which is going to be 25th of February 2012, and we are back in our regular time at 8 o'clock GMT, 10 o'clock local Cyprus time. Until then, have a nice time, and of course very good and profitable trading. Good luck.